If you own property in any of these states, you need to hear this now. The real estate crisis is already here. Florida just recorded foreclosure rates we haven't seen since 2008. 1 in every 2,182 homes hit with foreclosure notices in September alone. And behind the scenes, $94 billion in commercial real estate is hemorrhaging, with a $1 trillion loan maturity wall set to crush entire state economies in 2025 and 2026. We spent weeks analyzing data from the Federal Reserve, the National Association of Realtors, and state budget reports. 3 warning signs predict which states will fall first, and they're converging right now. Warning sign 1, a hidden banking vulnerability. Small and mid-sized banks hold 80% of commercial real estate loans, and are 5 times more exposed than large banks. Morgan Stanley estimates 190 banks face SVB-like challenges, a 10% loss on CRE loans, and over 100 banks become undercapitalized. Warning sign 2, a population exodus driving a fiscal death spiral. Weak states are losing residents, losing tax base, and losing resilience right as revenue needs surge. Warning sign 3, the commercial real estate maturity wall in 2025 and 2026. This will expose which state economies were built on quicksand. Let's start with the foreclosure crisis states, where housing markets are already imploding. Florida leads this disaster with 4,621 foreclosure filings in September 2025, the highest volume nationally. That's 1 for every 2,182 housing units. For full year 2024, Florida tied for the highest foreclosure rate at 1 in every 267. Condo inventory ballooned to 8.2 months of supply. Mortgage delinquencies rose 17.89% from Q4 2023 to Q1 2024, driven by property taxes that surged between 2019 and 2024, and skyrocketing insurance costs after Hurricane Ian. Nevada remains America's foreclosure capital, with 1 filing for every 2,417 housing units in September 2025. The danger: a 1,750-day average foreclosure timeline, the longest in the nation, tied to an economy dependent on volatile tourism. Unemployment is the highest in the U.S., at 5.8%, and visitor counts fell 1.2% in 2024 versus 2023. South Carolina posted the worst foreclosure rate in June 2025, at 1 filing per 2,426 housing units. Lenders repossessed 51% more homes in February 2024 year-over-year, after pandemic-era price growth decoupled from incomes. The correction is now sustained. Rounding out the foreclosure crisis, Delaware, Illinois, and Indiana. Delaware logged 1 filing per 2,325 units in September 2025, second worst nationwide. Illinois hit 1 per 2,883 units with 13,000 plus foreclosure starts in 2024 and 2,858 bank repossessions, the most after California. Indiana reached 1 per 2,697 units, with mortgage delinquencies jumping 53 basis points quarter-over-quarter. Now the fiscal collapse states, budget disasters creating systemic risk. California faces a structural deficit approaching $20 billion annually, even after closing a $46.8 billion gap in 2024. The corporate exodus is real. 156 HQs left San Francisco and San Jose, 106 left Los Angeles since 2018. Tesla, Oracle, Charles Schwab, Chevron, gone. California ranks dead last on a U-Haul Growth Index for the 5th straight year, with 197,000 net domestic outflow in 2024. Los Angeles alone lost over 100,000 people. Illinois carries a $143.7 billion pension crisis with only a 44.6% funding ratio. Nearly 20% of its entire budget goes to pensions. Population decline continues, 60% outbound moves in 2024, 33,000 residents, lost in 2023, erosion since 2014. Maryland was the only state Moody's downgraded in May 2025, losing its AAA rating. A $1 billion structural deficit this year is projected to reach $5.9 billion by 2030. Households carry a 1.97 debt-to-income ratio, 3rd highest nationally, and the 4th highest per capita credit card debt at $4,190. New York's deficits accelerate from $1 billion in fiscal 2026 to $7.1 billion in 2020. Net domestic outflow, 153,000 residents in 2023, 4 straight years of decline. Projections show the state could lose over 2 million people by 2050 and multiple congressional seats by 2030. Here's the hidden banking risk. Commercial real estate exposure is concentrated in small and mid-sized banks. If office, retail, and multifamily loans reprice into higher rates with lower values, the capital holes get real fast. California leads the CRE disaster. San Francisco office vacancies are 36 to 37%, highest in the nation. Offices are selling at 80 to 90% discounts from peak. CoStar's index shows office values down 34% from Q4 2021. Apartment distress is rising, and 20% of California office owners plan conversions within 3 years. Texas has $59.3 billion in CRE exposure despite strong fundamentals. Austin's office vacancy is 27 to 28%. Dallas-Fort Worth CBD sits at 26%. Houston shows elevated distress. Community banks hold 55% of all CRE loans, and in Texas, 74% of community bank portfolios are concentrated in CRE. Illinois compounds its pension and budget issues with CRE risks. Chicago leads the nation with $4 billion in office distress. CBD vacancy nearly doubled from 11% to 21%. The Chicago Metro had 1,976 bank repossessions in 2024, highest among all metros. Washington state faces the crisis through Seattle. Office vacancy 26.7 to 27%, highest in the western U.S. Office visits are up only 16%, still weak. The state faces a $12 billion deficit over 4 years. Now the multiple vulnerability states, the ones with converging risks that make them sitting ducks. Alaska ranks as America's weakest state economy in mid-2025. No state sales or personal income tax. Heavy reliance on volatile oil revenues. About 40% of the state budget comes from federal funds. Mississippi ties Alaska at the bottom, second highest poverty rate at 17.3%. Roughly half the state budget depends on federal funds. Employment growth was just 1.3% in 2024, too little to cushion shocks. Louisiana is least prepared for a recession, only 8.6% in reserves dead last. Highest poverty rate at 18.9%. Highest mortgage delinquency rate nationally. Colorado fell 14 places in readiness. Worst household debt-to-income ratio at 1.1, 110% of annual income. Highest per capita mortgage debt at $59,400. Property taxes surged 52.9% since 2019. New Jersey leads outbound migration for the 7th straight year, 60% outbound. Highest property taxes in the nation at 2.47% of home value. Worst business climate ranking. 1 in 5 outbound movers chose Florida. Oregon's growth is stalling. International trade is 25% of GDP, with 14% tied to China. Serious tariff exposure. Tax revenue fell 19.3% below the 15-year trend. Population decline and heavy Portland outmigration. Arizona and Utah face high home price decline risk. Provo, Orem flagged with 70% plus probability of declines. Inventory is back to pre-pandemic levels after unsustainable price gains. Georgia's pressure is mounting. Mortgage delinquencies rose 14.96%. Property taxes surged 51.5% since 2019. Atlanta spent most of 2024 on high-risk watch with a 70% plus probability of price declines. Here's the bottom line: roughly 1/3 of U.S. states, representing nearly 1/3 of GDP, are already in recession or at high risk as of October 2025. Common threads: structural deficits consuming 10 to 20% of spending, foreclosure rates 2 to 4 times the national average, population decline eroding tax bases, and CRE stress threatening regional banks. When the $1 trillion maturity wall hits through 2026, and when vulnerable banks absorb losses, 3 states will experience the first and worst contractions. Entire state economies could face lost decades of stagnant property values and fiscal strain. If this is valuable, please take a second to like, subscribe, and share. It helps a lot and keeps us motivated to bring you the data others miss. Now let's zoom into Texas, the real estate giant showing cracks in 2025. Median home prices across Texas are down about 3.2% year over year, to roughly $331,000, over $70,000 below the U.S. median. Austin leads the decline at 6.4%, followed by Dallas at 4.1%, San Antonio at 3.5%, and Houston at 2.8%. Inventory surged 30.7% to more than 132,000 active listings. Homes take about 105 days to close, longer than last year. This marks a sharp reversal from the 2020 to 2022 surge driven by low taxes, cheap land, and corporate relocations like Tesla and Oracle. Back then, listings vanished overnight. By 2024, supply doubled and sellers lost control. With mortgage rates hovering between 6.8% and 7.2%, affordability became the ceiling and demand slowed hard. The psychology flipped. In 2021, buyers feared missing out. In 2025, they fear overpaying. Bidding wars disappeared. Sellers are offering concessions, covering closing costs, buying down rates, throwing in incentives. This isn't a crash. Texas didn't overbuild like 2008, and population growth remains solid. It's a recalibration, a repricing of risk. Affordability is the choke point. A $330,000 home at 3% was about $1,400 a month in 2021. At 7% in 2025, it's more than $2,600 before insurance and taxes. Middle-class buyers are being priced out. Sellers either cut prices or wait months. Inventory is higher, but sales are down about 1.5% statewide. Insurance makes it worse. Premiums are up 20 to 40%, especially in Houston and along the Gulf, after billion-dollar storm losses and wildfire risks. Insurance can add $200 to $300 a month, killing deals. Lenders want larger escrows, pushing closings past 100 days. Carriers are pulling back in flood zones, and even minor FEMA map changes can freeze entire neighborhoods overnight. Liquidity is drying up. Deals still happen but slower, and only after price cuts or heavy negotiation. Pause market is the theme. Transactions crawl, momentum stalls, and micro freezes hit after a single Fed sentence hinting at delayed rate cuts. Storm-related insurance moratoriums can halt coastal markets within hours. Buyers now watch rates like weather. Meanwhile, Texas's growth model is straining. No income tax attracts people, but limits funding for infrastructure and housing support. Zoning backlogs, staff shortages, and higher building costs slow everything. Developers in Austin and Dallas say permit times doubled. Houston's flood rules and inspections add friction. Delay becomes the default, and the market feels sluggish. Texas isn't one story, it's several. Austin is hit hardest. Tech layoffs and luxury overbuilding push prices down 6.4%. Dallas-Fort Worth is mixed, some suburbs down 4%, others flat or slightly up on corporate inflows. San Antonio slid 3.5% as insurance and taxes offset affordability. Houston is steadier on oil jobs but pressured by insurance. Smaller cities Waco, Tyler, College Station are bucking the trend with modest growth from remote workers and retirees chasing value. This is 2025, not collapse, redistribution. Demand is migrating from overheated metros to balanced mid-sized markets. The frenzy is gone. Patience and negotiation rule. By late 2025, expect prices to stay flat or dip slightly, with a potential rebound in mid-2026, if rates ease. Texas fundamentals, job creation, population growth, pro-business policy still stand. Scoreboard, median price around $331,000, inventory up 30.7%, time to close at 105 days, sales down roughly 1.5%. For buyers, this is a time to get pre-approved, watch rates, and be selective. For investors, it's a targeted buying window, focus on cash flow and insurance risk. For homeowners, this isn't a crash, it's normalization. Across the country, about a third of states are either already slipping or right on the edge. The debt, the demographics, the delinquencies, and the office glut are converging. The data doesn't lie, and smart money is already moving. If you found this helpful, hit like, subscribe, and share it with someone who needs to see it. Then watch our next deep dive, because what's coming in 2026 will separate the protected from the exposed.